My name is Akira with Streets Creation Studios, and we will be talking about maximizing tax return. I will be giving you a little information about Streets Creation Studios. About us is our mission is to empower youth by providing tools and resources for financial literacy and entrepreneurship. This innovative enhances job readiness and college preparation, fostering a better future. All right, so our programs and services that we do provide, we have a youth program called Catch My Debt, which is about financial literacy and entrepreneurship. And we also help out with jobs, college readiness, scholarships, and soon to have a summer program. And the resources that we have available for our community is housing, renting, food, clothes, health and life insurance, business, and workforce. And the services that we provide at a reduced price is reduced tax service, web designing, business consulting, notary service, call center, health and life insurance. All right, our promise is to educate and provide sources and tools to our youth and community. Today's presentation is about maximizing your tax return. We will be educating those single head of household, filing joint, and separate individuals and business owners. Educating the first time employee and what are the different forms. Section 1, different filing status, which is single head of household, joint or separate filers, and business owners. We have other ones, but we're going to dig into the ones that you mostly see all the time, the common ones. So we have the single filer. A single filer is basically a person that is unmarried on the last day of the tax year, which is December 31st. You do not qualify for other filing status such as head of household, married filing jointly, married filing separately, or qualifying widower. So to understand if you are a single filer, you will have to never been married, legally separated, or divorced under the state of law, or you are widowed and did not remarry during the tax year, and you do not have a qualifying dependent that would make you eligible for a head of household. And why does this matter? Is the tax rate, the standard deduction are based on filing status. Okay, so like as a single standard deduction is 14,600 for the IRS applies the single tax bracket to your taxable income, which has its own income ranges and tax rates. So, for example, if you are unmarried, live alone, and have no dependents, the IRS will expect you to file as single. You'll get the standard deduction for single filers unless you choose to itemize. That's when you're trying to maximize your refund. And your tax will be calculated using the single filer tax bracket. All right, so this is some different things that you would want to do to make sure that you can maximize your tax return. Okay, so you have gather all your income and documents for your deductions. Then you also want to determine the best filing method. Contribute to tax advantage accounts. Contribute to tax advantage accounts, okay? Claim all eligible credits because if you don't claim them, they're not going to give them to you. So gathering the documents and the deduction documents are the W-2 forms, the 1099 forms for the side work, interest, and dividends, okay? Record all unemployment benefits, Social Security, or other income, bank and investment statements, receipts for deductible expenses such as charity, education, etc. Then determine the best filing status for yourself. Okay, so decide between standard deduction, 14,600 for single, and itemized deductions. Okay, if you're if your total itemized deduction like mortgage, interest, state, local, state, up to 10,000, charitable deductions, medical expenses over 7.5% of your income, etc. Exceed the standard deductions, then that means go ahead, itemize. You could get a bigger refund. Keyword, you could get a bigger refund. Okay. Contributing to tax advantage accounts, such as traditional IRAs, contributing up to 7,000 in 2024 if you're under 50. Okay, so now 2025, we're in the year 2025, but this is just information. It keeps going. You will get newer information. Just stay tuned to YouTube, Facebook, and all of those things that I have. Then you can also go to our website, streetscreationstudios.org, and be able to go on our blog part of the page. And we have these things up there even for the new year. So you'll have this video there if you want to just go in and look at it and write some notes down and figure out, okay, I need this document, I need that document. So let's go into it some more. And then we have the health savings account, the HSA. That's when you have a high deductible health plan and you are contributing contributions are deducted and tax-free for medical use, but you are contributing to it as well so that you can be able to save money on when you have to go to a doctor's appointment and you want to keep putting money into that account. It helps pay for the co-pays, surgeries, or any other little things that is needed if the health insurance does not pay for it. Okay, so then we also have the 401k or similar employer retirement plans. Listen to this keyword: pre-tax contributions, lower taxable income. You want that. Any benefit that your job gives, you want to ask, can I have it pre-tax? I understand everybody's trying to hold on to every dollar. But when you get ready to file taxes, you will have a what? Lower taxable income because you are already pre-taxed. Meaning, so if you pull on that, you don't have to worry about paying that particular tax. You've been paying it already. Okay. So then here we go. Claim all eligible tax credits. We have the EITC. Okay. Earned income tax credit. Even singles with no kids may qualify for the low to moderate income. Then we have the savers credit for contributing to retirement accounts. Income limits apply though. Okay. American Opportunity Tax Credit, AOTC, or Lifetime Learning Credit, education costs. Okay. So you'll get a form for that. Then we also have the clean energy and EV credits. I know I've been talking to a lot of people about this. They probably think I'm crazy, but if you change your light bulbs in your house and it's clean energy light bulbs, keep your receipt. You are able to write that off. Okay. And then they even have the EV credits, electric vehicles. So for qualifying home improvement, if you have a refrigerator that is clean energy, write it off. Okay, so then let's go ahead and finish up with this. We have the track deductible expenses. Just track your deductibles. Okay, so you have student loan interest up to 2,500, self-employment expenses if you are a freelancer or a side hustle. If you have your office within your home, even if you're working and you work from home, you are also able to deduct that because you are providing that for that company, okay? And for you to be able to work. So if you're self-employed and you qualify, yeah. I can't even talk. Charitable donations, cash and goods. You have medical expenses above the income threshold. Then you have moving expenses only if active duty military, okay? Then you have the time for payments and purchase. Make extra mortgage payments or charitable contributions before the end of the year to increase deduction. Pay medical bills within the same tax year to meet the medical expenses threshold. Prepaid deductible expenses if it will help you itemize. I know y'all like, I don't want to prepay nothing. I don't want to give up no extra money. I want to keep my money. I understand. I do too. But I look at the fact when I get ready to file, I ain't got to owe nobody. Okay, so you know how it is. The world goes around. We all owing everybody. That's how it is. But we got to figure out how to go around that to not owe so much or don't owe anything at all. But it's all about learning and Google and understanding. Double check withholdings. If you consistently owe a tax every time, adjust your W-4 with your employer so more tax is withheld. I've been saying that too to my clients. Sometimes it's okay. Go on that W-4 form, put additional amount that you would like to be withheld so that you won't have to worry about penalties or paying out more money because now you done made too much and you didn't give enough. But this can avoid underpaid penalties and may lead to a what? Bigger refund. Bigger refund. Or you don't have to pay nothing and you may not get nothing back, but it's better than you even have to pay anything. For a lot of people that are single filers, you normally pay something. And I know you like, oh, I'm so tired. I always paying. But how about just go ahead? You know you're gonna pay at the end of the year. Just take that money now and have them to go ahead and withheld extra. Okay. So we all know about filing electronically. Everybody likes to file electronically because everybody want their money when. I need my money when now. Okay, so we know how that go. Streets Creation Studios, we help out with getting your money now. Or you can go to any other of these professionals or do it yourself. Just make sure that you are being very educated about what you are doing, understanding what is going on. It's Google. I'm giving a little bit of here and there on this. If you need more help, feel free to contact me on streetscreationstudios.org. You can go on there and be able to find my information and contact me at any time if it's anything you need. Okay. So I'm just giving a little bit here, and then you have the video to go back to the reference to. So, head of household. Everybody loves the head of household, who's the part of the head of household. Because of why? Larger standard deduction than a single filer. And what? Lower tax rates than a single filer. Okay. And we have the same income sometimes. But we got the pennies that we taking care of. So that's why we don't have to worry about too much of that. Because we taking care of some people. All right, so then you qualify as a head of household if all of these are true. You are unmarried or considered unmarried on the last day of the year. Not, 20 and 26. I ain't married no more, so I'm going to file. I'm going to go ahead and file, and I'm on head of household. Nah, boo. Ain't finna happen. That's when later on they gonna audit and you gonna be like, oh, I shouldn't have did that. But it's on you, but I'm not telling you to do so, okay? Consider unmarried means you are still legally married but have lived apart from your spouse for the last, listen to how I'm saying it, y'all. The last 6 months of the year and met certain other rules, okay? You paid more than half of the cost of keeping up your home during the tax year. Costs include rent, mortgage, utility, property taxes, insurance, repairs, and food eaten at home. You have qualifying dependents who live with you for more than half the year. Usually your child, stepchild, adopted child, foster child, or other close relative who meets IRS dependent rules. So yeah, your grandmama, your auntie, your cousin them, you gotta have the proof though to your cousin them who you been taking care of. You don't let him stay up in your house and he don't ate up all your food and you taking care of him. Oh yeah, you head a household. Okay, boo boo. For a dependent parent, they don't have to live with you if you pay more than half of the cost of the main home, like a nursing home. Okay. All right. So benefits HOH versus single. I know y'all hate it. Those ones that don't have no kids, they wishing they had them. They out here like, I need a child to claim. I need them. I need it right now. I'm trying to not owe this money. Okay, anyway. So single standard deduction is 14,600, like we said before. The tax breaks is higher rates at lower income. Listen to the key word, higher rates. So you getting a tax higher on lower income. You like, what in the world? This don't make no sense. It don't make no sense. I know it don't, but it's just how the world is. Okay, y'all. Okay, so head of household, 21,900. Lower rates on the same income. The standard deduction is a little higher than the single. Ain't that something? For example, if you earn 50,000, filing as a head of household could save you hundreds to over 1,000 compared to a filing as single. Mm, mm, mm. Whew, child, I know. When they get to that tax time, everybody be dreading it. Like, oh my Jesus, here we go again this year. Ugh. Okay. And then here we go with some quick examples. Maria is unmarried and lives with her 10-year-old son. She pays all rent, utilities, groceries, and other household expenses. I told you, cousin and them, because she meets the dependency and cost requirements. She files as head of household and gets a what? Bigger tax break. Okay. I'm be like her. All right, that's how I want to be. I be wishing that the kids don't never grow up sometime. When it hit tax time, I be like, God dang, how many kids I got now? Oh Lord, I got that one. I can't claim that one no more. Oh Jesus Lord, no. But anywho, we're gonna keep going. So then we have here, we want to make sure that you meet the requirements. Okay? Make sure it is. Before anything else, make sure you qualify. Do y'all see this? Do you see this right here? Qualify. Okay. A lot of people be doing some stuff. Okay. Anyway, unmarried or considered unmarried on the last day of the year. I keep stressing that on the last day of the year. So if you just got divorced on December the 25th and it was done and finalized, baby, you had a household if you got some dependents, okay? So pay more than half the cost of keeping up your home. Have a qualifying dependent who live with you for more than half of the year. Okay. Now let's gather all of these documents, the income document, deduction documents, like the W-2s, the 1099s for all jobs and side jobs. Okay. Proof of dependence residency. I can't say that word for something. I don't know why. But anyway, school records, medical records, and lease agreements. You got that lease agreement and school record. Okay. So then we got the child care receipts. Yes, your grandmama. I know you are the, yeah, I don't pay. I don't pay. I pay my grandma, my auntie them. I sure did. Okay, so then you got education expenses, charitable contributions. Then you have the retirement contributions, which I keep stressing again, pre-taxable, baby. Make that money maximize. All right. So then you have tax I'm sorry. Take advantage of the higher standard deduction. That's what the HOH. I'm sorry, singles. It's okay. 21,900 standard deduction. You also itemize. If you the itemizing deduction mainly comes in when you have your mortgage interest, state or local taxes up to 10,000, charitable giving, large medical bills, or higher than this. Itemize instead to reduce taxable income further. All right. So you got maximized child related tax credit. So you got the child tax credit up to 2,000 per qualifying child under 17, partially refundable. Additional child tax credit refundable portion of the CTC if you do not owe taxes. So I know a lot of y'all filing taxes and you sitting there like, well, I ain't get all my money because some of that went to paying off some stuff. You didn't know it, but it's gone. Okay, it's all right, but you still got you a refund. You got you a refund, but some of that went to go pay some stuff off. Okay, would you prefer it all came to you, then turn around you owe $10,000? No, I don't think so. So let's get to it. So child and dependent care credit. If you paid for daycare, after school programs, or babysit, so you can work. Mm, all right now. Did you just hear? Or if you paid babysitters so you could work. I'm letting you hear it. Grandma, auntie them. cousin. You done paid them. Make sure you write this down every day in your cash app. Paid babysitter, so you can print it out. Paid babysitter cash out. Paid babysitter cash out. There you go. There you go. You got you some maximized child related tax credits. Do you hear what I'm saying? Earned income tax credit can be worth thousands if your income is low to moderate range. Okay. Now, let's talk about reduced taxable income with pre-tax contributions. I ain't gonna keep going on this. I ain't gonna keep going on this. I see what it is. 401k, 403b, or the TSB contributions through your job. Okay. I know that the 403b is mainly for like school, police, let me see who else it is. Church, nonprofits, and then we have the 401k, normally it's like a traditional one where you working for like a corporate company. That may be police as well. So then you got the traditional IRA contributions up to 7,000 if under the age of 50 in 2025. We're gonna say 2025 because that's what it is now. All right, so we got the health savings account, HSA. That's when you are contributing to an account that you're saving money. So in case you have to go to the doctor and pay copay, or you got some deductibles you got to pay because you finna get a surgery or anything like that, that helps out. The flexible spending account helps out a little further. It helps out with medical, and then it also helps out with groceries or any other things that they feel like prescription and stuff like that. Okay, then we have track other deductions you may qualify for, like student loan interest up to $2,500. So you out there paying on your student loans, baby, you need to be keeping a receipt and you need to be filing it. Okay, so then here goes something I know y'all like. What? I did not know this. Job search. The money paid for job search? Oh my God. Yes, yes. Or self-employment expenses if you have a side income. Medical expenses above 7.5% of your income. So if your medical expenses is more than your income, at least 7.5% of your income, honey, just add up your income for the year and put what you was doing for the medical expenses out of your pockets and do the 7.5% of your income, and baby, that's what you're going to get help with, okay, to maximize your tax return. Then we have contribution donation, cash or non-cash. So when you up there going to Goodwill, dropping off them clothes, you need to be saying, "Excuse me, I need a receipt, please." Yes, yes, I need it on my taxes. Uh-huh. And when you go get that gas, I need that too. I need that receipt. Yeah, yeah, I need that receipt. Okay, so then you got education credits like American Opportunity Credit or Lifetime Learning Credit. Okay, so those are some deductions, and then you want to track those. Make sure, and then you'll see you may qualify for these tax deductions to help you maximize your tax return. Then considering year-end tax moves, okay? Prepaid deductible expenses like mortgage interest or property tax before 31st of December. Make additional charitable donations before the end of the year. Pay out some outstanding medical bills within the same tax year to maximize your deduction. And we all know everybody likes to choose direct deposit, or you want to get that advance loan, right? Because you ready now. I need my money now, right? Okay. So then you turn around and you come to me as your professional help. You, you get me? And I will help maximize your tax return as well because I have reduced prices. Let's go back though. So then we're going to talk about the joint or separate filers. So then we have filing joint or separate is about your tax filing status when you are legally married or on the last day of the tax year. So married filing jointly. You and your spouse combine your income deduction and credit tax on the one tax year. You both have to sign that return, okay? And y'all both are responsible. I'm gonna let you know that now. So if John owed $20,000, Lucy, you owe it to Boo Boo. So that money gone. All right. So I'm just gonna let you know that is the cons about that. Any penalties or liabilities of the other spouse is now yours if y'all sign and file joint. Okay. And then the largest standard deduction for that is 29,200. Lower tax rates for the same combined income compared to separate returns. And then eligible for more tax credits because of y'all joint together, EITC, child tax credit, education credits, and etc. All right. So then you have married filing separate. You and your spouse each file on tax return, reporting only your income deduction and credits. You are only responsible for your own return. So your pros is your money is your money, his money is his money. Okay. So if he got problems, John problems is John problems. Lisa problems is Lisa problems. And now y'all ain't got to worry about all that. But the cons is now your standard deduction is smaller. It's gonna go as you're filing single. So now it's 14,600. That's it. All right. So then you lose access to certain credits such as EITC, which is everything that everybody wants. You know, educational credit, student loan interest deduction, and higher tax rates on the same income compared to a joint filing. Okay, so let's give an example. If you and your spouse earn a total of $80,000, filing joint might put you in a lower combined tax bracket and qualify you for more credit, so your tax is lower. But if it was singly, remember now, 14,600. So if you up there with the 80,000, you already know you owe. So you better hope that you had them put some money up to the side. That's all I can tell you. All right, so then we got joint or separate filers maximizing tax returns. Still, we own it. Okay, decide the best filing status, y'all. It's decided. If you, John or Lucy, don't owe anything, go ahead and add that thing together. Y'all might marry for a reason. Okay, y'all got married for a reason, not a season. I hope so. So let's go on and get these qualifying more tax credits, like the EITC or the child tax credit or education credit. And have your standard deduction to be a little higher, 29,200. Get better tax bracket threshold than doing it separately. Okay, when you're doing it separately, it seems like you're losing a lot of credits and they putting you back to single, 14,600. You don't want that. So making sure again that you gather all of your individual and joint documents, W-2s, 1099s, investment income, business income, retirement income, receipts for deductions, charitable mortgage interest, medical bills, dependent information, social security, proof of residency. All right. Then you have the child expenses and provided information. All right. Maximize the deduction if jointly combined deduction expenses to exceed the amount of 29,200 standard deduction and considering itemizing if you own a house. Go on out there and be some homeowners. You know, first time homeowners, y'all really get it. Okay, so you got mortgage interest plus the property taxes, have a larger charitable contribution, have a high medical expenses over 7.5% of adjustable gross income. If filing separately, you both must either take the standard deduction or itemize. You cannot mix. But see, if you together, you can mix that thing. Go on and mix it. You feel me? Okay, max out pre-tax contribution. Max it. Joint filers can each contribute to the 401k or traditional IRA to reduce taxable income. HSA contributions you have a high deductible health plan. Dependent care FSA if you have child care costs. So you can also use that for that. Remember, I was telling you about that flexible spending account. You can use that for child care. Okay. Then we have some more. Claim all the eligible credits, like again, child tax credit, additional child tax credit, up to $2,000 of a child under the age of 17, refundable portion of the CTC. Then you have the earned income tax credit, only available to joint, not filers that are separate. Okay, so child independent care credit for daycare or after school care, American Opportunity Life Learning credits for education expenses. Then we have the Savers credit for retirement account contribution. All right, so then you have the leverage income shifters strategies, joint filers. Okay, this joint filers. If only spouses earn significantly less, move certain income producing assets or retirement contributions to that spouse to lower the joint tax burden, legal and documented transferables only. Consider bunching deductions into 1 year by prepaying expenses. A lot of people don't like that word prepaying. I ain't prepaying nothing. I ain't giving up my money. Boy, stop. Who you talking to? Okay. Be careful with married filing separate. Okay, the rules. No EITC. That's what everybody wants. Earned income tax credit. I don't work all this time and I can't get it. I can't get the tax, man. I don't understand. And then I'm up here paying on my student loans and I can't even use the interest deduction because I'm filing separate. So we done got divorced. But anyway, limited child dependent care credit, you can't even use that. Lower IRA deductions, phase out limits. Okay. But MFS can be smart if you want to separate liability for tax owed. One spouse has very high medical or casualty losses. All right. Again, electronically filing, everybody loves. Okay. Both with sign or only one sign. And use a tax pro or a complex situation. Understand. So bottom line is joint filers usually maximize refund by combining income. That was the whole reason of you getting married, I would think. This is a business transaction. I'm just playing, y'all. We just trying to maximize my return. Okay, that's why we gonna get married, John. That's it now. You don't own that, do you? You don't own that. Okay. Anyway, so here we go. Business owner filers. Filing as a business owner means you are reporting business income and expenses on your tax return because you operate a business or a self-employed, not just working for someone else as an employee. It applies whether you run your business full time or as a side hustle, whether it's registered LLC, corporation, or unregistered sole proprietor. What it means in practice, you are responsible for tracking and reporting all the money your business earns, income and spends, expenses. Okay. You file different tax forms depending on your business structure. So let's go through it. The business type, sole proprietor, single member LLC is a Schedule C with your personal form 1040. Then you have the partnership slash multi-member LLC, which the form will be a 1065 plus a K1 for each partner. Then you have the S Corp, which will be 1120S plus the K1 for each shareholder. Then you have the C Corporation. Form 1120 separate from your personal return, okay? You pay taxes on net profit, which is your business income minus deduction business expenses. Self-employment tax applies if you're not an S Corp or a C Corp. Covers Social Security and Medicare. You may have to make quarterly estimate tax payments instead of just one a year. Okay. You claim business deductions that employees can't. Office space, equipment, travel, advertising, etc. You are responsible for keeping good records in case of an IRS audit. So example, if you are a small business that is a small cleaning service and you collect payments from clients, which is income, and you deduct supplies, mileage, advertising, insurance, which is expenses. The profit left is, I'm sorry, the profit left is taxed as part of your personal income if you're a sole proprietor or a single member LLC. All right, section 2, employment forms and pre-tax benefits. I'm gonna keep elaborating on this pre-tax benefits. I'm just trying to get y'all to maximize your return. Okay, you got to remember this pre-tax benefits. So employment forms and information on pre-tax benefits. Notes: pre-tax benefits reduce your taxable income, but may also slightly reduce your Social Security and medical contributions, which can affect future benefits. Okay. IRS form W-4. Employees withholding certificate tells your employer how much federal income tax to withhold from your paycheck. You provide personal information, filing status, dependents, and any extra withholding you want. Any extra withholding you want. If you are a single person with no dependents, you need to do the any extra withholding you want. Okay, so that you can reduce the taxable income. All right. So then, if you live in a state with income tax, you may also complete a state W-4. Then you have the Form I-9, employment eligibility verification, proves you are legally allowed to work in the United States, which y'all all know about. You have your driver's license and then your Social Security card. Employers must keep this form, but do not send it to the government. It's for their records, okay? I'm gonna let you know this now. When you do your W-4 form for the state or the federal, I know a lot of y'all do the exempt. And when you do that exempt, I say 6 months, but that's what they say. But I would tell you to put your timer on for that fourth month, because sometimes your HR didn't get that and haven't changed it for you like they should. I know they supposed to make it now electronically, and sometimes you've been on one and did it, and then you go back and see that the next checks that you've been getting lately is still looking the same. You like, wait a minute, what happened? Oh, the system was acting up. So you see how if you go ahead and you do it within the 4 months, it gives it enough time so in case that it has some of those type of issues going on, you will still be okay. And normally if you do like exempt, you have a second job that you're going to allow them to fully take taxes out. Or you might even do additional minimum extra withholding on that first job that you have. So, okay, direct deposit authorization form, optional but common, gives your employer your bank account information so your paycheck is deposited directly. You will need your bank routing and account information. These are for people who have never been employed before. I'm just giving a little information on what you would be commonly seeing when you're hired for the first time, okay? And I do consider or say, let me see, not consider, I would say recommend that when if you have two or more bank accounts, make one of those bank accounts the one that you do the with extra withholding. If you do not do it where through your paycheck. So if you know that okay, I don't want to do it that way, I prefer to put it in an account and I just pay it at the end of the year, do that. Get an account where you just doing you paying off your tax. That's it. But you're gonna put I'm gonna do my own withhold. I'm gonna put my 25 in my other account. You can put more than one bank account when you do your direct deposit with your employee. So company specific new hire forms and emergency contact form, employee handbook, acknowledgement. Make sure you read the employee handbook before signing. A lot of people sign and don't realize what they signing. Okay, don't do that. Benefit enrollment forms, health insurance, retirement plans, etc. Okay, make sure that these benefits that you are signing up for is worth it. Sometimes the companies will have you sign up for health insurance because it benefits them, but it don't benefit you because of the fact that you're paying more with this employer, and then you go outside of the company and find something that you might get for free or you might pay less. Remember, you're not trying to work harder for yourself. You're trying to work at ease for yourself. You're trying to make your money work for you, but not as hardly working. Okay? So confidentially or non-compete agreement. Make sure you read these agreements, okay, when hired. All right, so let's go into the common forms. You have the W-4, as we spoke about, the state W-4, the I-9, Direct deposit form, benefit form. So the purpose of these things is the W-4 is to tell the employer how much tax to withhold. The state W-4 tells the employer the state tax to withhold. The I-9 verifies that you can work in the United States. Okay. Direct deposit form is allows the direct deposit to go in, yeah. And then the benefit forms to show you what type of benefits that you are eligible for and what you can get. But make sure that you know what you're doing and you're just not signing for anything. Here's the breakdown of the common pre-tax benefits. So we have the health related benefits, health insurance premiums, medical, dental, vision, insurance premium paid through your employer can often be pre-taxed. Health savings account contributions are pre-taxed if you have a high deductible health plan. That's why you heard that you can make sure that you file it. Flexible spending account for health care expenses, medical FSA, and dependent care DCFSA. Okay, dependent care flexible spending account. They have that as well. Okay. Then you have health reimbursement arrangement, HRA, employer funded, not usually deducted from pay, but the reimbursement are tax free. Okay. So then you have retirement contributions. You got the 401k, the 403b, 457b. Contributions are pre-tax, traditional, and reduced taxable income for the year. Traditional thrifting savings plan, TSP. We talked about that earlier. For federal employees and military. All right. So pension plans and employee contributions are often pre-tax. Then you got the commute transportation benefits, so qualified transit passes, bus, train, sub fares. Oh, ain't nobody heard about that one, huh? Qualified transit passes, bus, train, subway fares. Okay. Qualified parking, parking at or near your workplace. Mm, taxable. Let's maximize my tax return. Okay. Van pulling. Pulling. I know y'all's like pulling. Van pulling. Certain employers provide transportation. Okay. Group insurance. Group term life insurance. Premiums for coverage up to 50,000 are taxable pre-tax. All right. Let's go again. Group term life insurance premiums for coverage up to $50,000 are pre-tax. Amounts above that are taxable as income. Disability insurance sometimes offer pre-tax, but it can affect how benefits are taxed if you ever use them. Then you have education and training benefits. Employer provide Employer provide tuition assistance, okay? Up to 5,250 a year can be pre-tax if it meets the IRS rules. Then you have the job-related education costs if paid directly by the employer under a qualifying plan. All right, let's get some different tax forms. Yeah, let's get into it. Okay, so main individual tax return forms, Form 1040, which is the standard individual income tax form for most taxpayers. Forms 1040 SR, same as 1040, but designed for seniors, large print, easier to read. All right, Form 1040 NR for non-resident aliens. Then we have Forms 1040X, amended tax return to fix or update a filed return. Then you have common attachments to Form 1040, Schedule 1, additional income, unemployment, gig work, rental income and adjustments, education expenses, HSA contributions, and then you have the Schedule 2, additional taxes, AMT, repayment of certain credit. Then you have Schedule 3, additional credits and payments, education credit, foreign tax credit. Then you have Schedule A, itemized deduction, mortgage taxes, property taxes, charitable donations. I said donations. Schedule B, interest and dividend income. Schedule C, profit or loss from business for self-employed or sole proprietor. Schedule D, capital gains and loss for investment. Schedule E, supplement income, rental property, partnership, S corp, and trust. Okay, remember Schedule E. Schedule F, profit or loss from farming. And then you have Schedule SE, self-employment tax. Some more forms. I know y'all like, oh my God, this lady is going. Yes, I am. I'm trying to get this information to y'all. Common income reporting forms received from others. W-2, which everybody know. Wages and salary statement from your employer. Then we have the 1099 NEC, non-employee compensation, freelance contract work. Then you have the 1099 MISC, miscellaneous income, rent, royalties, and prizes. Then you have the 1099 INT, interest income from banks. Then you have the 1099 DIV, which is dividends income from stocks of mutual funds. Then you have the 1099B, sales of securities from brokers. Then you have 1099R, retirement plan distributions. SSA, 1099, Social Security benefits. Then you have the 1099G, unemployment or state tax refund. Forms for adjustment, deductions, and credits. We have form 8880. I know some numbers there, ain't it? Credit for retirement savings contributions. Then we have form 8863, education credits, American Opportunity Learning, Lifetime Learning. Sorry about that. American Opportunity Lifetime Learning. Then we have form 2441, child and dependent care expenses. Then we have form 8889, health savings account, which is HSA, contribution into distributions. Form 2106, unreimbursed employee business expenses, and it's limited. Form 5329, additional taxes on retirement accounts. Then you have Form 6251, alternative minimum tax. All right, that's a lot of forms, baby. Woo! I'm still going. I need some water. Then we have some more forms, and we finna end this, okay? Forms for business owners and investors. We have forms 1065, which is partners return. Forms 1120, C corporation returns. Then you have the form 1120S. S corp. I always say it. I always say S corp, C corp. It's me corporation returns. Form K1 reports income from partnerships, S corps, or certain trusts. Forms 4797 sales of business property. I'm sorry, sale of business property. In short, 1040 is the main tax form for individuals. Schedules report details of specific income or deductions. And you have 1099s, W-2s, and similar forms come from employers, clients, banks, and brokers. Special IRS forms apply for credits, adjustments, and unique situations. Whew, child, honey. I know it's a lot. And that was just a little bit that I just gave y'all. If anything else, like I said, if you have any questions, if you have anything you feel like I done missed on or I miscommunicated to you, and you like, hey, wait a minute, I need her to go back. She said that too fast. Okay, so just hit me up. Here it is, Streets Creation Studios. All right. Our tax service is open to new clients and referrals in person, and we have virtual filing tax return, mobile uploading, and able to check status. Discounted rates for low income families. Remember this. Thank you. Thank you. I get some water now. Thank you. But anywho, yes, thank y'all so much for being able to watch the video and see the presentation. I would love y'all feedback. Let me know what you think. Is there anything that you feel like I missed that you need information on, or would like me to do a video on it that you feel like, hey, I want some more information. I need more detail or to be more in depth of this right here because I'm kind of like, I be getting confused on this and I need a little help. Okay, so I am Akira Allen, the founder and the author. My number is 678-650-2878. Okay. And then if you want to reach me, email akira.allen@streetscreationstudios.org. Or you can also reach me www.streetscreationstudios.org and go on there and click on there and email me or give me some information. And I'm out.